Welcome to Real Estate with Redbeard. Hi, I'm Stephen Redbeard Verts, largest beard in real estate, and owner-operator of Wizards Real Estate. Now, this is a January 2023 market update. If you like this kind of information, be sure to like, share, and follow, as I will be sharing more informative videos about the real estate market, as well as home selling and home buying tips. Now, I want to start off with the reality of 2022, and that is that the 30-year fixed rate in this country doubled over last year. We started out at around 3.2% back in January a year ago, and we ended up right around that 6.4% as we wrapped up the year. While some were predicting that the market would possibly see those interest rates up to the 9 or 10%, I predicted early in the year that they wouldn't pass 8% and would most likely stay between that 6 to 7%, with the possibility of going a little bit over that 7% by the fall, which is exactly what happened. Keep in mind that we've never seen a year where the mortgage rates rose so quickly or where the mortgage rate doubled. All of that has certainly impacted the entire market. It kind of had this psychological effect across the entire nation. I think one of my main jobs right now is to help you understand what's happening. Now, if we go back over the past 21 years, we see the average 10-year treasury was hovering around 3.49%. The spread there about 1.79%, giving us an average mortgage rate of 5.28%. So if you take that treasury, you add 1.79 and you get the average mortgage rate. That spread rose where the 10-year treasury actually hit 4.02% in October and then trickled back down to 3.52% for this past January. So the spread was over 2.5% and the national average interest rates could be seen a bit over 6%. Right now they're bouncing between that 6 and 7%. Some people are still over 7%. It depends on many factors. Talk to your lender if you want to know more. As we see that spread decrease, we will see lower mortgage rates. And if the spread were normal today, we'd actually see interest rates more around that 5.5%. So there is a good chance that the interest rates will be between that 5 to 6%, but unlikely to dip under 5% throughout the whole year. The good news is that panic has been subsiding, which also means it's good news for long-term interest rates. The first part of the year, we actually saw people getting more uncertain about the economy. Things were happening. Panic was entering the equation. Around June of last year, the feds came out and actually said, we don't have this under control. We want to reset the entire housing market. We then saw panic go up again. And this is where, when we come to the end of this past year, and we started to see that panic subsiding, and the feds were then saying maybe the peak of the inflation is actually behind us. Lawrence Young stated, the upcoming months should see a return of buyers as mortgage rates appear to have already peaked and have been coming down since mid-November. One of the premier thinkers in the mortgage business, Dave Stevens, former Secretary of Housing, who also held positions at the MBA, said, so be advised, this may be the one and only window for the next few years to get into a buyer's market. And remember, as Federal Reserve data shows, home prices only go up and always recover from recession, no matter how mild or severe. Long-term homeowners should view this market right now as a unique buying opportunity. First, the one thing that is true right now about the forecast for home prices is that none of the experts agree. That is absolutely true. This is a look at the forecasters that we follow. They go from anywhere from a depreciation of 5% to an appreciation of 5%. The important thing to remember right here is that we don't see any of these reputable forecasters calling for a free fall in prices in the housing market. I've been telling people for over a year now that depreciation should continue, but more back to a normal range of around that 3% to maybe 5% for 2023, instead of that skyrocket appreciation we saw over the past couple of years. One of the interesting things that has been published recently was an article in the Wall Street Journal where they looked at the home prices, at the home price appreciation before the pandemic and then again after the pandemic. If you look at before the pandemic, from the fall of 2017 up until the spring of 2020, there's about a 12% home price appreciation in that 2.5-year time span. If you think about the 2.5 years going into this fall, since the beginning of the pandemic, what did we actually see? We saw a tremendous amount of appreciation across this country in residential real estate, 38%. Now, would it make sense that in some of these markets that, and in some cases, we'd see a little bit of that come back? Absolutely it would. But again, not a free fall in prices like some people in the media on Facebook, YouTube, other places like that. Some people have been saying that every home out there is reducing their price right now, but that is simply not true. The recent information we have from Realtor.com from November shows that if you look at this, the share of homes having their price reduced going all the way back to 2021, let's look at the graph right here. At the height of the most recent information we have from November, there was just over 1% of homes having a price reduction in the market. So again, not a free fall, not a situation where we're seeing every home having their prices reduced. Have home values hit their bottom? This is a look right now at Case-Shiller, FHFA, Black Knight, and CoreLogic, and their month-over-month home value change. If you isolate the last 4 months that what we have published, what we see in each case, the depreciation peaked in August. Now, I'm not here to say we're out of the woods, but what I am here to say is home depreciation is not a free fall. You're not seeing it drop and continue to drop. You might see a little bit here and there coming forward, but not this huge decline in home prices. Do not believe everything you hear in the media. If you take the December sales report, you can see that over 11,000 homes sell every day in this country. The proof of that is the math on the screen. Just over 4 million in the existing home sales report, divided by 365 is just over 11,000 homes every single day. That also means that 8 houses sell every minute in this country. Again, I put the math here on the slide here. You take that 11,000 number, divide it by 24 hours, 467 every hour. Divide that by 60, and you see 7.8 homes sell every minute. Remember, as we see panic subside, we're going to see those better mortgage rates. If we become slave to inflation and what the Fed is doing, and we're out of control, then there's nothing we can do. But we can use information provided in order to better grasp what is happening and what may happen soon. You may benefit from alternative means of financing. I think that's critically important right now. Like I said before, talk to those lenders. Adjustable rate mortgages and rate buy-downs, a 2-1 buy-down or seller concession that's applied to a buy-down is very, very good for those looking to buy right now. And here's a couple of quotes on that as we think about that. First, from the Urban Land Institute, they say, the risk of ARM's adjustable rate mortgages were substantially mitigated by the regulatory reforms put in place after the 2008 bust. Today's adjustable rate mortgages is not the risky products of 2008 or even the pre-bubble version. ARMs are no longer something to fear. In fact, they could help borrow or save money and reduce barriers to home ownership. So you need to have great realtors and lenders working together on your side. If you think about rate buy-downs, this comes from Real Estate News. Temporary rate buy-downs are a hot trend for mortgages as borrowers face higher costs for home loans. Some buyers are exploring alternatives to the traditional mortgages in a period of rising interest rates that is expected to continue into 2023. Buy-downs are a less costly alternative to a traditional fixed-rate mortgage. As I said earlier, we might see those between that 5 and 6%, so things are changing. I'm going to wrap up here in a minute, but I wanted to break it down this way. As you start to look at information and the data that's out there, one thing becomes true. Active listings over the past 2 years have grown. We wrapped up 2021 with just about 450,000 active listings in this country. We wrapped up 2022 with just about 750,000 listings. So that's the first point. We have more listings today. But what do we also know? Pending listings have decreased every month since the beginning of the last year. They were stable month over month from February to March, but each month have trickled down, meaning pending listings is an indicator of velocity and demand in the market. So if there's less pending listings, that also means there's less sales. So you have inventory increasing, pending or demand decreasing. What does that mean? We may see more expired listings if the trend continues, but the spring market is around the corner and it always brings in a lot more buyers. And this will be another great army if interest rates drop again. As always, we're grateful for you watching. We're grateful for you investing this time and understanding what this market shift actually entails. Be the informed buyer or seller in the market, and be sure to follow me on the socials, as I will have an updated video about the market in the next couple of weeks too. Until next time, my friends, Redbeard out.